ask a question, Rachel?
That depends on the question, Kay, but why don't you try?
The workbook that you attached the link to is the national workbook, but that's not the syllabus we're going to be following today, is it?
Correct. That is a link to the national workbook. It has a lot of good information in it. Some of it is not California specific, so we will not be following that workbook. But we will be linking it again in the chat today, and I will be sending it out via follow-up email with the handouts from today. And any other pertinent information that happens to come up. Because sometimes when we're talking about things, we get cool links.
Right. So we will get specific handouts for what's talked about today.
Yes, ma'am. So after the program, after the program today, I will be sending you the PDF handouts. I will try to link them in the chat while the speakers are talking. But sometimes it's a little bit much. But you will get a follow-up email from me today and tomorrow with the handouts. I
mainly asked that because last time it was people were getting confused.
Yes, no, thank you for that clarifying question. You will be linked to the National Handbook for those who are coming in. You will be linked to the National Handbook, but it is not California specific and there are some discrepancies in it. So it is good information and we want you to have it. However, we will not be following it for this course. However, you will be emailed after this course the handouts for each of the presentations. Information. All right, and we have a lot to cover today. It is 9 a.m. and we are going to get started with our script.
Good morning, everybody. I'm Jennifer Richardson. I am the California North Chapter President. We'd like to welcome you to our Board Leader Certificate course, day 1. We'll be here tomorrow as well. The California North, Bay Area and Central California and the Orange County Chapter really enjoyed putting this program together for you. We hope that you learn a lot and enjoy it. We would like to start off by saying a quick thank you to the combined education committee members that worked on this program. Charlotte Allen with Social Insurance Agency, Ashley Brandt with River City Reconstruction and Painting, Wendy Miller with CAM Construction and Painting, Miranda Ward with Adam Sterling, and all of the chapter executive directors and staff that were involved in this. As Rachel mentioned earlier, we will be posting a link to the PDF version of the CAI Nationals Board Member Toolkit in the chat for you, but we will not be following the book for this course. The book has a lot of good information in it, so we want you to have it, but National put it together as general information for all of the states, and we have some California specific information for you. So Rachel will be sending a follow-up email to everybody with the PDF handouts from the information that is covered today by our speakers. She's going to try to post it in the chat if she gets a chance, but if not, for sure you will get it in a follow-up email. Certificates for the course will also be sent to you to the email address that you registered with within a week with the name of the association provided in your registration. If you need to make a change to that, please let us know. We want to make sure that you get your certificate. We couldn't do any of this without the sponsors. So we would like to let our event sponsors have a couple of seconds to say hello to you. We do have one of our event sponsors here today, and before I let her speak, I would like to mention the others: Laura Angus with Bright View, Erica Erskine with Cyclone Eco Power Wash, Suzette Beck with Real Manage, and Brenda Lynch with CID Consortium LLC, who is here with us today. So Brenda, if you'd like to say a few words.
Good morning, everyone. And Kay, thank you. This is going to be a great program. I've attended programs in the past for CAI, and this chapter always does a great job. CID Consortium provides community association management, and we also provide accounting services separately for those folks that need just that piece of it as well. Don Haney, our founding member, has been in the industry for over 50 years. Adam Haney, his son, is our current president and CEO. And again, we are happy to be a sponsor, very much believe in the education that this brings to everyone that's in attendance today. So thank you for letting us be a sponsor and participate.
Thank you, Brenda. Also, there will be a $5 Starbucks gift card that will be sent to all homeowner leaders at the conclusion of the event tomorrow afternoon. If we cannot confirm that you are a homeowner leader at an association in California, you will not be sent a gift card. We have had some scammers that have tried to infiltrate our events just to get a free $5 Starbucks gift card, which I find incredible. So please make sure that we have your correct information so that we can get that to you. Okay, with that, on to a little bit of housekeeping before we get started. We are recording this meeting, so please keep your microphone on mute. We will be taking questions via the chat function at the bottom of the Zoom screen that will be answered at the end in the order they were received. We will also take questions live, barring time constraints. We have a lot of information to present here in 2 hours. It is being recorded, will be posted to YouTube. So if for some reason with the Q&A, we end up going over time a little bit, we apologize for that. And if you have to get out of here right on time today, just know that the entire program will be posted to YouTube. So it will be available to you. So don't worry about missing out on any of that. And then there will be time at the end of tomorrow's program for further questions. Please make sure that your name under the participants list on Zoom is your correct first and last name for attendance. If it's not, please, you can hover over your name on the participants list. You can click the 3 little dots, click rename, and then put your correct information in there so that Rachel has that to verify your attendance. Handouts will be posted to the chat and sent out via the survey tomorrow afternoon. If for some reason you can't get the handout from the chat, or for any reason you don't get an email, you can email Rachel directly, Rachel@New Level Management, which is abbreviated MGMT. So Rachel@newlevelmgmt.com, or you can just reply to your confirmation email that you got. And with that, I will get off the screen so that you guys can get on to what you're actually here for today. The first session, Finances and Reserves, Budget Season Starts Soon, is being presented by the GOAT, Robert Browning of Browning Reserve Group, Stefan Murphy of Allied Trustee Services, and Daniel Heaton of Nordberg DiNichilo. Correct me if I'm wrong on that one, Daniel, LLP.
DiNichilo. Sorry.
Okay. So speakers, you're up. Thank you for being here.
Well, we're happy to be here today. I'm going to start out and then we'll turn the time over to the GOAT. But my name is Daniel Heaton. I'm from Nordberg DiNichilo. It's a law firm that has exclusive clients with community associations. That's all we do. That's all we represent. Today, as mentioned earlier, or at least this first panel, is dealing with a lot of the financial issues of an association. We're going to talk finances in general and your obligations as a board member. And then Bob will talk about reserves, and then we'll turn the time to Stefan for collections issues. It's a lot of information, like we said. The PowerPoint that we're going to be working off today has probably more information than we'll be able to get through and talk to specifically. That's why we're going to give it to you later. But I do want to underscore that utilize your resources in each of the chapters. The people here with CAI are amazing. They're wonderful. They want to help you. Reach out if you have questions on any of these that we can't get to today, and you probably will. Utilize your local chapters and ask those questions so you can best serve your associations. So on to finances. One of the first things that we want to underscore is what your duty is, what your primary focus is. And really it is as owners and people that represent owners, it's to protect the value of your properties. I mean, you bought into an association because there's significant property value benefits that come with living in an HOA or a condo association. And so one of your primary responsibilities as a board member is to protect that value. Okay, flip to the next slide. In order to do so, you have to maintain those finances that come around it. That comes with it a duty to levy and collect assessments. And we'll talk more about that towards the end of the period that we have today. But also a duty to be aware of, understand what's going on, and manage the HOA finances. It's what's known as a fiduciary duty. And those are the highest duties imposed by the law. It's the same duty that I have with my clients or a doctor has with their patients. It's that level, it's that important. And so the stuff that we talk about today and tomorrow going into those duties are things that really need to be taken seriously. And if you do have questions, like I said, reach out. We're going to talk about the finances in kind of 3 phases. And I picked the first one, this planning phase, to go first, because most of the time in HOAs, everything is connected to the fiscal year. And in most HOAs, that's at the end of the year itself. Some are in July, some stagger because of your documents. But if you're like most associations that have it renew at the first or the end of the year, that means you're pretty much going into this annual budgeting phase right about now, getting ready now, doing the reserve studies that you need, looking at that, and Bob will talk about that in a second, and working with your management companies or the rest of your board to put together the budget, because the deadline for getting those all out is before December 1st. So we're coming up on that. And I'm going to leave the reserves, all the reserve stuff for Bob. He's a big expert there, and focus on the annual budget section. As kind of a broad overview of this, the budget just gives you the roadmap for how you're going to go about the next year in planning community activities, controlling the operations, deciding exactly how you're going to do the expenditures, and then setting the assessment values for the association. One thing I do want to underscore, though, is that, a lot of people get very, very concerned with, oh, we're not right on our budget, or we're not over, we're under. The budget's an estimate, okay? It's a tool that you as a board have to set expectations as a board in order to be able to move forward and assess the community. If you're finding that all of a sudden something big breaks down, and Bob will talk about this, and you need to change that budget and figure out a way to pay for it, you have the tools and you have the ability to do that, to go outside of whatever set at the last year. So realize that it's an estimate for guidance, and that it's something that's flexible if needed. It serves as a plan of action for achieving your objectives. It serves as a standard for measuring your performance as you reflect back on how close you came to that budget and whether or not it was realistic for the last year. And then it also serves as a device for coping with potential future expenditures that you have. Next slide. One of the big things that we hit here with the annual budget is that it's integrally tied into your assessments. And this comes from the Civil Code 5605, and it specifically indicates the limits that you have as a board of director on how much assessments you can increase, whether or not you can specially assess, and what those ranges are. And specifically, it says in terms of the regular assessment increase from year to year, you get up to 20% of the assessments from before. The special assessment increases, if you have to specially assess throughout the year in order to raise additional funds that you didn't expect for, that can be done up to 5% of whatever your budgeted gross expense is. So you're capped at that. And if you need to raise more than that, that's when you have to go to the membership for a vote for approval. So if you need 6, 7, 8%, the membership has to approve that, with the exception of specific emergency special assessments. I want to point out that go to 5610 for what the term emergency means, because that's extremely limited. And essentially, it's only 3 areas, okay, where it's ordered by the court in terms of litigation, where it's necessary to repair or maintain a part of the common area because of a threat to personal safety or property. Power lines are coming down and it's going to cause this huge turmoil. Then, of course, you can jump in and specially assess to take care of it right away. And the third is a repair or maintenance to the common area that you couldn't have reasonably foreseen. And that's a wonderful legal term that means whatever the lawyers want to essentially, couldn't have reasonably foreseen something as you're planning for the annual budget. So litigation expenses over the course of the year are usually reasonably foreseen. So you can't necessarily count that as an emergency special assessment. Some quick repair that you weren't able to see as you're planning for the next year can be an emergency special assessment. If that is required, the board has to pass a resolution. It has to say why it was necessary, why it couldn't have been reasonably foreseen, and that resolution needs to go out to the membership, at the time that the notice of the special assessment is asked for. So that's really kind of the broad framework for putting together the annual budget and how it ties to whether or not you're able to increase the assessment. Your obligations as board members continue well through the year, even after you've done the annual budget. And that's the second phase of evaluation. It's a monthly obligation. And really what this obligation is that you are required as board members to consistently review and go through all of the financial documents that the association has. And generally, when you have a management company that you work closely with, these will be pulled and provided and given to you as part of the packet. If you're a self-managed property, then it's something that you will need to come together and pull together each month as a board to look through on your own. But it consists of a number of various financial statements that you will need to review each month. The balance sheet, and we'll talk a little bit about what these mean in just a second, a couple of them. A revenue and expense report, the check register or the general ledgers of what's coming in and out with the line item specifically of everything that's happening. Delinquent homeowner reports or reports of which properties have been sent to collections that Stefan will talk about in a little bit. Or if there are certain invoices for your vendors that have been unpaid, it's that report that will detail which ones are overdue and what's needed to be, which checks are needed to be written in order to pay your vendors. I'm going to focus really quick on the first two, and that's the difference between the balance sheet and then a revenue and expert report. And again, I encourage you as board members to utilize the individuals around you, specifically if you have a management company, to help you understand what each of these documents mean so that you're aware of and you know exactly what the picture and snapshot is that you're being given with these documents. But a balance sheet essentially gives you the financial position right then and there. Like, how is the association doing right now today as I read this? To see exactly what type of liabilities and equity that you have. By comparison, the revenue and expense report kind of shows the results over a period of time. So you can see exactly how that changes from point to point. And the value of these two sheets, specifically the balance sheets, is you can then take that snapshot that you have and compare it to, say, last month or even last year to see exactly how our association is doing from point to point as we go forward and what type of adjustments we need to make specifically as you're going into the period for making your annual budget in order to make sure that we handle all our expenses and our future perceived expenses with reserves. The next slide gives the Civil Code 515. I'll let you take this and go back to it, but essentially this is the provision that gives you that specific requirement that you have to go through and review on a monthly basis all of these individual documents. It was updated and added, and these currently right now is everything that has to be reviewed on a monthly basis by the directors in order to make sure that the finances are on track and that they're aware of exactly where the association is so that decisions can be made in the context of correct financial responsibility. I will point out that if you go to the next code right after this, 501, that is a provision that does allow the board to delegate that responsibility somewhat and say that either every individual member of the board or can create a subcommittee of the treasurer and one other director to review and come back and report. But even with that, that provision also requires that the entire board review and ratify that summary of that subcommittee. So there really is that obligation that every director holds to make sure that they're aware of exactly what's going on. And if you remember when we first started out, it's a fiduciary duty, which means it's that very high level that if it's not being done, that's when you potentially open yourself up to maybe personal liability because you're not handling your fiduciary duties. So make sure that you're reaching out and utilizing the resources to understand exactly what that is. The last phase is activities near or after year end. And that's essentially putting together the reports that go back to the membership. And there are three specific areas that need to go back. There's annual policy statements and annual budgeting reports. And you'll see that there's a list of various things that go into those types of statements and reports that go out. And this is why I said that, we had to get everything by December 1st for most associations, is because those have to go to the membership at least 30 days before the end of the fiscal year. So for those that start your fiscal year on January 1st, these have to go out at the end of November or earlier, so that the membership has those types of statements and reports. And that includes policies regarding ADR, IDR, or enforcement policies, your collections and lien policies, and then your reserve study, which Bob will talk about, and then all of the operating budgets that you've just been put together. All of that goes out to the membership. After the close of that financial period, so starting January 1st, most individuals, there's also a year-end financial report that has to go out within 120 days. And the scope of this depends on exactly how much revenue your particular association has. If your association is under $75,000, then really that's just a compilation that can be put together with your board and your management company that goes out with those reports about what's happening. If it's $75,000 and above, then a CPA, a licensed CPA, is required to perform an annual review, giving an opinion with limited assurances based on their review of the documents. It's not a full audit, but it's a CPA review that has to go out within those 120 days. What are the consequences? If these documents aren't sent out, it means you cannot raise your assessment without a member vote, no matter how much you're trying to raise it. So it really is important that these financial documents are reviewed, they're understood, and that they go out within the right time period, because it limits your ability to move forward and do other things that you need to do in order to raise those assessments. Essentially, if those don't go out, again, it goes back to a full membership vote. And I don't know about your community, but most communities, and at least the clients that I work with, it's almost near impossible to get the membership to come out and vote on anything. So make sure that you're taking care of these responsibilities, that you're reviewing the documents, that you're reviewing the things that you need to do in order to make sure that these reports and statements go out at a particular time, so that you can make sure that you can handle what you need to do in order to raise those funds, help pay for the needs of your association. And with that, I think we're moving on into the reserve portion. So I'll turn the time over to our GOAT to take over at this point.
Thank you, Daniel. Yeah, my wife's been calling me a GOAT since 1979, so I'm not sure.
We're finally.
I finally met it. Anyway, thank you all for having me today. My name is Bob Browning, the Browning Reserve Group, and appreciate this opportunity. Of the three phases of the financial cycle, two of them are looking backwards, as Daniel said. One of them gets to look forward, which is the reserve study. And that's the one part of the financial cycle where it's not as black and white as the other two, where you're looking into the past, and hopefully the past can only happen one way. Well, the future's yet to be written, So reserve studies are more of like an art and a science of budgeting. The real definition, though, is reserve studies are a budget planning tool, which does two things, basically. As you'll learn, the reserve study identifies or creates a status, it identifies the status of the reserve fund, but it also, and more importantly, is designed to create a stable and equitable funding plan in the future. So every member who lives in a community association over time will pay their fair share for the large capital items that the association is responsible to take care of. So what's really important to realize is what a reserve study is not. It's not a home inspection, an architectural inspection, an engineering report. It's purely a budget tool, which through art and science helps us predict the future for the large expenses at your community association. So in doing so, what are some of the things the reserve analyst does when they take on a new engagement? Well, the first thing we do, and this usually happens at the bidding part of the process, is what type of association are you? Are you a condominium or a townhouse? You'd be surprised how often when we get calls from board members and even managers where we ask them that question and they'll say, well, we're a townhouse. And we're like, well, that's not really the legal organization. That's the architectural description. We need to know condominium plan development. And I don't know if there's any of you here today, but stock co-ops also are required to have reserve studies in California. So once we know the legal organization of the community by looking at the governing documents, we need to now look also in the governing documents, or what's the responsibility of the association, so we can develop the component inventory, which will then allow us to do a condition assessment of each component that the association's required to maintain on behalf of the association. So that includes the useful life, remaining life, the cost of the component, and so forth. So on this slide, everything in black, that's on the expense side of the reserve study. But all reserve studies have two parts. Not only the reserve expense side, where the analyst will try to predict how much will the association expend every year for the next 30 years out of reserves. Once the analyst can answer that question, we go to the flip side of the reserve study, the second part, which is the financial analysis, where I have that in blue, where the reserve analyst will tell you the big question that you're looking to answer is, what is the recommended contribution to reserves for next year's budget? So as Daniel said, right now, we're in the heat of budget season, and with many of our clients, we're working on their 2024 reserve contribution, which is just one line item in the overall budget Daniel just talked about. And so some reserve studies can be as thick as a phone book, if you all remember what those are, and others might just be, 20, 25 pages, if there's just a few components. The financial analysis will also disclose the percent funded or the fund status. Remember, under the definition of a reserve study, one of the tools of the study is to determine the status of the reserve fund for disclosure purposes. And disclosures are really important in California, and there's a lot of them, and they have to be done every year. And so we're going to spend a few minutes talking about those in a few minutes. Next slide. So what type of reserve study do you need? Well, for decades, there were three types of reserve studies. In the last few years, there's been a fourth type introduced. We're not going to talk about that. That's level 4 at the bottom, because in California, we have a Department of Real Estate process that takes care of that part of the budgeting for new communities, where we determine a reserve contribution before the community is even built in the design phase, so the developer can learn what their financial responsibilities may be imposed on the members before they even start building the project. most of the reserve study world lives in level 1, 2, or 3, which is a full study, which is the most exhaustive study, usually done at the first opportunity after the community is built and turned over to homeowner control. The other time when we will recommend a full study is if you change reserve analysts. So if your community's been doing reserve studies for 20 or 30 years and you've used the same analyst continuously, that's great. You're only going to need a level 2 reserve study every 3 years after that. But if you switch reserve analysts, sometimes it's good to go back to a level 1 study. It's usually not much more expensive if at all, but that reserve analyst is going to want to do their own quantifications of the quantities because they're going to own those numbers once their name is on the study. So full studies aren't done just the first time. They're often done maybe every 9 to 18 years or so on a 3-year cycle. But most of us live in the world of an update with site visit. So under the Davis-Sterling Act, at least once every 3 years, a reserve study, which includes a diligent visual inspection of the accessible common areas, must be undertaken. And it's identical to the full study. The only difference is the update with site visit will not usually do any quantifications of the components. They won't remeasure the roads or recount pumps or anything because those were done during the full study. The level 3 update without site visit, that's the annual update that as of around 2005 was required. The last time the legislature really substantively changed the reserve study laws. And so in the years when the site visit is not required, there is the requirement in California, although it's not expressly written this way, it's kind of obliquely a requirement through the disclosure process that at least an annual update without a site visit is needed for most community associations in California. And so the only difference between that update without a site visit and the others is all of the component condition assessment information is provided by the client. The analyst doesn't go on site and put the eyeballs to the components. So those are the 3 levels of service. So back to the frequency, as I guess I jumped ahead, you need to make sure that we conduct a diligent visual inspection at least once every 3 years, review the study annually. And as we're going to discuss under disclosures in a minute, the funding plan must be transmitted to the members with the budget packet every year. All right, go ahead. So what needs to be in a reserve study? Well, we do classes on this that are hours or a day long. So this is going to be kind of truncated. But all of the components that have a remaining life of 30 years, since the collapse of the condominium with the terrible tragedy in Florida a few years ago, the National Reserve Study standards through CAI have been changed, and they are on the CAI national website if you go to the credentials page. But we have now allowed in the national standards components with a useful or remaining life greater than 30 years. So we can try to prevent future tragedies. Even though reserve studies aren't designed to prevent those things, they're helped to do the maintenance to keep those things from happening. But there is no hard and fast rule with that only items should be in the reserve study with a life less than 30 years. That's kind of a myth that's out there. It's the typical definition, but it's not how reserve studies are working these days. Again, the cost of the components, and again, they're under number 4, back from the expense side to the funding side. That the whole bottom line of the reserve study is to help determine the reserve contribution for the following year for the budget. So really good to start working on your reserve study before you start working on the operating budget. And that's probably one of your pro tips for the day, is you can never start working on your reserve study too early once your fiscal year has started. And sometimes that may mean working with your reserve analyst through the year to ensure everything is going to get captured in that reserve study properly. So, as I said, the reserve study has two main parts, the physical analysis and the financial analysis. These graphs are more, these thumbnails are more as graphics than they are spreadsheets that we're going to get into today. But on the physical analysis, there's the list of components with the useful life, remaining life, all the variables about a component. And then the funding analysis, again, is 30 years of inflows and outflows, with the key being the reserve contribution for next year. Back to the physical analysis. The physical analysis should reflect the current condition of the assets. So when the reserve analyst is working on the reserve study, even in the years when we're not going on site, by working with the board members or manager, we really need to learn how the components have fared since the last reserve study. So with the winter we had in much of California last year, that's really was a stress test on many of the reserve components. So like if you have been having roofing problems and your roofs went through last winter fine, that probably was a good stress test for your community, that maybe your roofs aren't as in poor shape as you thought, or as many of us learned with our trees, maybe our could have done a little more tree maintenance. The condition assessment will change from year to year because it's got to reflect reality as your conditions age, and so will the life and valuations from year to year. Okay, we'll just go on. We're not going to get into that. Thank you. So for each page in the reserve study, there will be a page with the metrics for all the components. So every reserve study should have the quantifications, just square feet, linear feet, count, however that item is quantified. In the site visit years at least, there should be a photograph of the component, any topical observations made by the reserve analyst at that time, and with all the typical useful and remaining life attributes for that component. The financial back, I know going kind of back and forth on from the physical to the financial, but they are really interrelated. So the funding plan is the most important section of the study. That is where it's going to tell you going forward how much needs to be contributed to reserves starting with your next budget year. I've listed here just the first 6 years of a typical funding plan. But this is where the rubber hits the road. For board members that are comfortable working with the reserve studies, when we give them the first draft, the first place they go is, what's the recommendation for next year's reserve contribution? And so in this example, it would be in the second row for 2024. The reserve contribution is $135,703. And that would be the number that would be the focal point for the board. The other area of the funding plan that's important but not critical is the percent funded assessment. Under the Davis-Sterling Act, we're required through the disclosures to provide the percent funding status for the first 6 years of the funding plan, and that is required to go to the members. So percent funded is important in that respect, but it's usually not the main goal we fund to for most clients, but every client is different and it's up to the board. All right, next slide. Okay, disclosures. As I wrap up here, disclosures again are really important in California, and there's a lot of them, and they're spelled out pretty well in the Davis-Sterling Act. What's interesting is the disclosure 5570, the third one on this page, that's the 2-page disclosure that has to be executed and distributed each year with your budget packet. That's only been around since about 2005. Before 2005, there were still many disclosure requirements that were required and still are. And I think some of the perception for managers and board members was once 5570, the 2-page disclosure was adopted, that the other disclosures went away, and they really didn't. And what's good in this curriculum is CAI has remained steadfast to remind us about all the other disclosures, such as a summary of the reserve study, where at least you have to provide in summary form the component information. The other and third one on the page in the middle there is just the copies of the funding plan must be distributed annually to the membership. All right, next slide. And there's a couple more. If there's a deficiency in reserve funding, that has to be disclosed. And the oldie but a goodie that's been in the Davis-Sterling Act since it was instituted, you always have to disclose as an association to the members every year if there is a special assessment or not on the horizon. Okay, my last topic is borrowing from reserves. You can in California, boards can, if needed, borrow from reserves. There's a specific process in how to do it that we don't have time to go through today, but it's spelled out in the Davis-Sterling Act very clearly. Most of it's on this slide, but the board in an open meeting can decide to borrow reserves for almost any purpose. And as long as some rules are followed, it's more under Daniel's bailiwick, but the repayment has to be within 12 months. So it's really a short-term loan that can be extended with the board action at a properly noticed meeting. But there is the option or opportunity for borrowing short-term from reserves in California, which is good. Not all states allow that. So please talk with your legal counsel or manager if you have questions on that. So usually if you have to borrow reserves, you might be having trouble collecting assessments like has happened in the past. So we're going to segue over to Stefan. Thank you very much.
Thanks, Bob. So the next exciting topic, assessment collections. We'll spend a few minutes on this. Bob and Daniel have covered a lot of information that we know is important to board members, but it looks like we're keeping good time here. If you've got specific questions, I see a few of them have popped into the chat. So as we hit through this last topic, if you've got questions, chat those in, and hopefully we'll have an opportunity to get to those before the end of our session. So assessment collections are critical to maintaining the fiscal health of our nonprofit organizations. I'm talking to you from an HOA in downtown Sacramento. Our company is based in a commercial common interest development, so we walk the talk here at Allied. If you don't have the full membership participating and paying their regular assessments, it can really throw a wrench into your budgets, your reserve studies, everything. It just really rolls up. So assessment collections are, fortunately, most associations really don't have really out of balance assessment collection issues with most of their homeowners, especially in California, where recently, well, for the past several years, we've seen continually rising property values. So we just don't have some of the issues that typically other parts of the country experience. However, in the last year, lender foreclosures are up 20%. over last year. That's pretty significant to note. They're nowhere near what they were in the last housing downturn starting in 2008, rolling all the way up into 2012. It's nothing like that, and the economic conditions are different. However, it's important to pay attention to what's happening with those aging reports that you're receiving either from your accounting firm, or if your association is professionally managed, then your manager is putting these in your board packets. Which of your homeowners is looking to be, which ones are delinquent and might need a little assistance? It is critical for board members to have a broad understanding of how the non-judicial lien and foreclosure process works. It's some very specific code written into Davis Sterling. I'm going to talk about it a little more in depth on the next slide. But understanding that there is this very specific tool that is available to common interest developments, planned communities in California is critical. It does not mean that you are forcing your neighbors into foreclosure. The process is lengthy. I'll address the steps here in just a moment. But it's important to remember that the board is always in control, or the board always should be in control of this process. So understanding the tools that are available to you to get your neighbors to comply in paying their regular assessments is important. One of the key pieces that you have here is the collection policy. So part of your annual disclosures, it's important that you have a collection policy. You should review it with counsel to make sure that it is still meeting the needs of the community. It should be simple and it should be specific. The civil code that references what should be contained within this document is Civil Code 5730. A single page is sufficient. If a collection policy gets into multiple pages, it can actually create problems down the road in managing the collection process. A collection policy also needs to comply with the other governing documents. Sometimes in our business, we see that a collection policy has been adopted, and maybe it's an interest rate or a late fee. But elsewhere in your governing document hierarchy, like you're in your CC&Rs, it may be written as a different number. And so we look for compliance to make sure that all those documents mesh correctly. And it's important to adhere to the policy. And this helps the association avoid claims of discrimination from one homeowner to the other. When you adopt your collection policy, stick to it. If the aging report indicates that certain homeowners are so far behind in paying their dues that they should be sent to collections, then send them to collections. Treat everybody the same at that stage. And we'll talk about how you can manage differences in your homeowners, your neighbors, once you enter into the collection process. It's also important to have an active agreement with a provider. Choose a provider that you can onboard with now, so that should you need help with collections, you already have one on deck ready to assist you, because otherwise it may take the board a couple of months or even a couple of quarters, depending on how frequently you meet, to find a provider that is going to get you what you need. So have one now ready to go. Reliability, look for a provider that is known in the industry. Talk to your management companies, talk to your other board member colleagues, even board members with other associations. I know you network with each other, so talk to them about who's had good success and who hasn't. Choose a provider that's specializing in California. At the beginning of this session, we talked about the resources that are available at the national level through CAI, and yeah, those are some great resources. But as the fourth or fifth largest economy in the world, we have some laws that apply differently to community associations than to the other 49 states. It's important to choose someone that really understands the law in California. A board should also understand and be aware of what these providers are charging your homeowners. I recently saw a statement from a firm, an association seeking help. They had assessment dues owing of about $3,000, but the legal fees attached to the owner's account totaled $9,000. And the board hadn't really been reviewing the statements, or actually, in this particular case, the board hadn't received any information from the collection provider. So they didn't really have any idea what was happening with this delinquent owner. So it's important that, yeah, it may be a minor thing because you don't have a lot of delinquent homeowners, but if you do, make sure that you're remaining involved in the process, that you understand where you are at each step. The most important tool that a board has in California is something called the Notice of Delinquent Assessment. It is the lien. And so using the non-judicial foreclosure process, again, written into the Davis-Sterling Act, the association has a series of statutorily required steps, time frames that are adhered to, and just recording that lien early in the stage provides you with a way of securing that debt, such that if the owner then goes to sell their unit during the escrow process and the actual sale, the association will receive an escrow demand, and you will be able to communicate to the title company exactly how much money is owed to you, and it has to be paid during that escrow transaction. If the association does not have a lien recorded, the homeowner is not required to pay those delinquent amounts owing to the association in the sale process. So getting the lien recorded is a critical step. And fortunately, in this series of statutorily required steps, it's very early in the process. Within about 45 days of the association referring an account to a collection agent, the lien can be recorded. That's how quickly it can go. Judicial foreclosure is also a path that is available to homeowners or to associations. It's typically used when we have a deceased owner situation or we have process service issues. Davis-Sterling requires that we personally serve all of the owners, but what if your owner doesn't live in the area or even in the country? There are times when judicial foreclosure, even though it's typically much more expensive and time-consuming, it may be the path that you have to explore. Small claims court and superior court are also paths available to associations to recover debt. Typically, we see small claims and superior court used when there is a lender foreclosure in your community. A bank that forecloses on one of your neighbors will extinguish the lien that we've recorded on your behalf. The bank takes ownership of the property. The now former homeowner moves out. The association still has paths to choose to try to recover those delinquent assets. And then something called request for notice is something that an association can record one time on all units within the community, such that if a lender is foreclosing on one of your units, if you've recorded request for notice, the lender must notify the association that they have foreclosed on the unit within 15 days of doing so. This came about after the last housing crisis, when lenders were foreclosing and they weren't notifying. There was a lot of lender foreclosure activity, and they wouldn't notify the association until they had probably sold that property again to an investor or to an individual. And it could be months before the association knew really who owned that property. And then once that transfer takes place, some associations would have to pursue legal remedies against that lender to try to get the back payments. Having request for notice or RFN recorded on every unit in your community is a good way to help protect against that. For my last slide, let's take a look just at what the statutorily required steps are in non-judicial lien and foreclosure process. You'll see here in the beginning, and this is where your collection policy is so important. I mentioned earlier, if members are delinquent and your collection policy indicates that they're delinquent, whether it's 60 days or 90 days, or whatever the period is that's written in the collection policy, if they're delinquent, then they should be put into the collection process. And everybody that qualifies should be treated the same way. Once a lien is recorded, this is the step that secures the debt, protects the association in the event of a sale or transfer of that property. Once the lien is recorded, now the association, the board, can gather information about the particulars of this, of each owner that's in collection, and you can treat them differently. You are not required to proceed along this path to foreclosure, not at all. The significant step here is getting the lien recorded, securing the debt, protecting the association. But using your business judgment rule, using data that your collection provider can provide to you, such as the status of the home, status of property taxes, bank accounts, everything can help the board then choose to treat different accounts, different delinquent accounts differently. And that's really important. Just because you enter this path does not mean that you need to continue along the path. And the board the provider, the collection agent should indicate at every step that the board is in control. You can stop the process, you can halt the process, pause, whatever you want to do. And that is my last slide. I know we've covered a tremendous amount of information here, but we really appreciate, all of us really appreciate your attention and participation today. So I'm going to turn this back to Rachel and Jennifer and see if we've got questions for any of the three of us.
Hi guys, one second. I'm trying to remove spotlights. Okay, now we can see everybody. We do have a couple of questions on hand. First off, I am going to read this out loud, even though Bob answered it in the chat in case someone missed it. And because we are recording and no one can see the chat, we're going to run through this. What is the importance of percent funded? It fluctuates. So what does it mean and how is it used? And Bob responded, percent funded is important as it relates to financial disclosures. Most associations do not use it as a funding goal, but some do, and that's okay. The important funding goal is ensuring after all invoices for reserves are paid in any given year, there is a reasonable threshold in reserves at the end of the fiscal year. This is threshold funding. And yes, we are all sorry that we are condensing this, but you guys got through a lot of information. I have our next question.
Rachel, really quick, could I tack on an additional follow-up on that one?
Yeah.
I have a lot of clients, Bob, that are consistently worried that they're not 100% funded or near 100% funded. Should they be, what would you recommend in terms of when they're looking at that? You said it's not the main go-to, but if they're not 100% funded, what should they be thinking about?
If they're not 100% funded or at least 70% funded, then that could be an indication of a major problem. So, but being under 100% by itself is not a red flag, but it may also be in tandem with another issue. But the main goal, like Rachel just read, is ensure that your threshold at the end of any year over the next 30 years is reasonable with your income stream coming in. But most associations are fine living in the 70% or higher area of percent funded. But don't ever use, pro tip, don't ever use percent funded by itself as a metric of adequacy, because you'll be sorely disappointed if you do.
Thank you all. Okay, our next question came in for Bob. If the HOA is helping owners with dry rot repairs and the expense will be paid from reserves, and when owners pay their share, the payment is put into reserves, is this considered borrowing? Does this need to be recorded in the minutes?
I'd say no. That's a legal question. I would say no.
I would support that decision.
Thanks.
And again, it really depends on the circumstances that you have, and you, like Bob said in his slide, go to your legal counsel and make sure that they rubber stamp and approve that, because it does depend what you're borrowing for. One of the additional components in the Davis Sterling that wasn't on the slide is that there's another completely separate requirement if you're borrowing for stuff like litigation and additional steps that you have to go through and make sure that you're knocking out. So make sure that you're working in tandem with legal counsel so that you check up all those boxes so you don't get in trouble.
Yes, and we are trying to be a little less specific. So
Yeah.
also, we have a next one. What is the best initial practice to collect assessments when transitioning to a new management company?
Ooh, a definite caution is to make sure that you have a complete ledger from the current management company for every homeowner that is delinquent. One of the requirements that an association and a collection agency have is that we must show, when we're recording a lien, we must show a ledger back to the last zero balance or credit balance on a homeowner's unit. And we see this regularly, that a new management company takes over and an owner is in arrears and they start with a balance on their account, and that's where their bookkeeping begins. And when they get referred to the collection agent, they either have to substantiate that prior balance that came from the first management company, or we have to clear that amount off and we have to write it off. So we work with a lot of management companies that no longer manage the HOA, and we can usually get what we need. But if you're changing management companies, a smart move is to make sure that you have a complete ledger for any owner that shows up on your aging report, a complete ledger from the current management company, so that you can then hand that off to the new management company. They're going to want to have complete records back to the zero or last credit balance for that particular delinquent owner.
Thank you, Stefan. We have one last question that came in. We do want to be respectful of our next speaker's time. Again, we did say in the beginning, we are recording. So if we do run over and you need to leave, it will be posted. The last question that I got was, can you put a lien on a home and not pursue collection?
Yes, you can. Getting a notice of delinquent assessment lien recorded by the HOA on the unit is, you don't have to proceed any further than that point. That's it. The nature of the delinquent assessment lien is that in the normal course of life, the amount that you've recorded, the written amount that you recorded on the lien, can grow. The amount that is due in escrow can be more or less than what was written on the lien, because it's considered an ongoing lien. So record the lien and you do not have to proceed at all.
Thank you. Big thank you to our first session speakers. We sincerely appreciate you. When I do send out the email, I will make sure to include their contact information if you would like to get a hold of them. And I'm going to turn it over to Jen to introduce our next speakers.
Thanks, Rachel, and thank you all for your information. Just a quick reminder, I do still see a few people that have not changed their name. So if you want to get credit for the course and get that all-important Starbucks gift card that scammers are even trying to get, please make sure that your name at the bottom of your little video box shows your first and your last name. Moving on, our next session is preventative maintenance, deferred maintenance, full replacement, and the cost benefit. It is being presented by Bill Mann of the GB Group, Richard Williamson of Covington Community HOA, and Carly Melius of Professional Association Services. So speakers, take it away. Thank you for being here.
Thank you very much. So Bill's going to drive.
I am driving here. Hold on a second. Here we go. Did my screen come through? Yeah. Okay.
Yep, sure did.
Very good.
So let's go to the next chart, Bill, and you can see the three of us that are presenting today. That's us. Happy to be here. And I really have to give a shout out to all of the board members who are participating in taking this training. You're part of an elite group. Most board members never do anything to learn about their fiduciary responsibilities or responsibilities as a board member. So you're an elite group who are learning about how to work with your management companies to run your associations. And we're very, very pleased to see you here. I serve on
Yeah,
three
it's a
HOA
Big commitment,
boards.
big time commitment. So,
It is a big time
Yes.
commitment.
so
And I have to tell you, out of three boards, I'm the only person who's done any training or was involved in CAI. So it's very rare. And again, thank you very much. So let's talk a little bit about the purpose of maintenance. In addition to the fiduciary responsibility that we heard a little bit about in the reserve session, and I sat through the reserve session because I'm a board treasurer, so I'm very involved in reserves and maintenance and expenditures. We have a responsibility to do maintenance over the long term to take care of our assets. Years ago, I knew a mechanic who had someone come in with a car that had broken down. The person was very proud that they had never ever had the oil changed. That was just a ripoff by car dealers to, take their money. Of course, they never saved a dime, which we would call reserve, to replace that engine when that engine seized and had to be replaced. It was beyond being repaired. So we're going to talk a little bit about the purpose of maintenance and also about full replacement costs. And the key thing with doing the maintenance over the long term, doing your planning, hitting those markers that you see in your reserve study on the life expectancy of components, with a few exceptions. If you do that, you're going to preserve the value of the property, and you're going to reduce your long-term problems because you deferred maintenance. And I live in a community that did defer maintenance, and the last 2 years we had over $250,000 of unplanned maintenance. This year we're going to spend more than $1 million in planned and unplanned maintenance and construction defect repairs on an 18-year-old community. Again, part of that was planned maintenance, was scheduled maintenance was not done because the boards saved everybody money, kept the assessments low, and now the hens have come to roost. So that's the big challenge. If you
Richard, what kind of deferred maintenance did they not do?
So let me give you an example. We have steel fences. We live in a golf course community. We have steel fences, tubular steel. They call them wrought iron, but they're tubular steel. They did not properly do corrosion control maintenance, didn't get them painted properly. They just painted over rust. We had rusting fences that were actually a danger to the owners and the residents. And we ended up spending over $365,000 to replace fences at year 15, 16 that should have had a 25+ year lifespan if they had had proper corrosion control and maintenance done on them. Now that we've spent $365,000, we have an annual corrosion control and maintenance contract to make sure that we take care of those fences. So that's an example. The one thing that I would say that I do not use the reserve study to replace automatically are things like heating, air conditioning, and hot water heaters. We have those serviced every year. Again, preventive maintenance. We have those serviced every year. We get feedback from the professional service technicians that are licensed California contractors. And as long as things are working well, we're going to continue to get long life out of those components. So while an air conditioner technically is a 10-year item, we're at year 18. We're going to take it as far as we can. And I've just written an article that will be in the Orange County edition of the OC View in the September-October edition. And Rachel, I'm going to kick it up to you guys and in your area once we get the final edits on it. But the key thing is the rules are changing on refrigerants, and what you want to do is make sure your HVACs are taken care of, that they are maintained as long as possible, because by 2030, we're going to be on a completely different system. And if you do the wrong things, it will cost your associations. So again, combined preventive maintenance, plan for long-term replacement, and be funded for both. So I think we should go to preventive maintenance.
Okay, so there's 3 types of preventative maintenance. You have your planned maintenance, time-based, and usage cycle-based. In real life terms, that means be proactive, not reactive. So when you are going in and looking at your reserve study and you're looking at useful life for usage cycles. So if you are looking at your roofs and you've had your roof done recently and it has a 35-year or 30-year lifespan on the roof, it should still be maintained every 3 years. So proactive, keep your costs down. Bill, do you have any?
Deferred maintenance. So I think Richard's example of the fence is like, pristine example of deferred maintenance and having a component fail early. Happy to hear that you guys are maintaining your HVAC systems. Those are typically very overlooked in homeowners associations. So it sounds like that's working out quite well for you. So maintenance items, deferred maintenance is items that, lead to premature deterioration, the common area components. And I think, Carly just mentioned, roof system, just because you put a new roof on doesn't mean you can turn your head and not maintain it. You might maintain it a little bit more towards the end of its life, but even when it starts off, it's important to have those systems checked and maintained, and anything that needs to be corrected. Postponing these items only causes more expense down the line repairing it. Richard, did you have any issues with code upgrades or anything on your projects you're working on if it's an older community?
Minor with the code upgrades. We have a construction defect issue, and we've had to do over $125,000 worth of repairs from the rains this last winter. So there are some minor code changes there. They're not the driving factor, but I have run into that. For instance, I had my son's house in a 100-year-old home in Fullerton rewired. It still had live knob and tube wiring. So I made sure I had a licensed contractor. We pulled permits. We did it by the book. And because the code has changed, we had to do things differently than they did it 100 years ago. And that increased the cost to some degree. So I would expect with some of the things that we are doing that we're going to find those kinds of issues, but they have not been a tremendous issue until maybe we get into balcony inspections. If we find something where code is changed on like a elevated walkway. I think
you're going to find if they require current structural calculations and stuff like that on things like wood decks, balconies, and entryways, particularly in a community that's 20 plus years old, there's going to be a lot of code upgrades or at least system upgrades. And no offense to the reserve study guys, but they don't always know what the city's going to require, what's going to happen, and different things happen. We had an association that went through, did an SP 326. Matter of fact, it's one of Carly's company's associations, and we replaced a bunch of entry decks. And at the end of it, the city came back and said, "Oh, by the way, you have to inspect all your sewer laterals in order to close out the permit." And then, $60,000 worth of sewer repairs later, we're closing the permit out almost a year later afterwards. So some of the things that are happening with these deferred maintenance projects, and this was a deferred maintenance item, if they had maintained these entry decks, they wouldn't be going down this, and they wouldn't have had to have their sewer laterals inspected. So there's different things that come up that really can impact the finances of the association. And, typically I don't find associations that are deferring maintenance are usually cash rich. So having components completely fail just kind of puts them in even a worse scenario than they were in before.
So full replacement. One of my communities is a 390 unit condominium complex. Takes a full city block in the city of Anaheim, 4 stories plus a parking structure. It's 18 years old. The CC&Rs state that the air conditioners, the HVACs, are owned by the association because they're on the roof and because of the unique requirements to be able to maintain those. When I bought there in 2013 and the 2014 budget and reserve study review, I pointed out that there was not a line item in the reserve study to maintain the air conditioners or replace the air conditioners. There was nothing in the operational budget to do annual maintenance on the air conditioners. And the board agreed and put it in. And then the next year I was on business travel when they had that, and the board didn't want to pay that bill, so they took it out of the reserve and they took it out of operating. So no annual maintenance was done on 400 air conditioner units on the building. And now we are at year 18 and we have about a $3 million air conditioning bill that is not funded. And units are having to be replaced. And again, the article that I mentioned to Rachel about, I just wrote an article about the changes in the laws on R22, R410A, and the new Puron Advance and things like that, gases that will be used. This is going to have a tremendous impact. And because maintenance was not done and is still not being done because we don't have the funds to do it, the systems fail and we have about a $12,000 replacement cost. So we've been replacing R22 systems with R410 systems, and that gas will no longer be produced starting in 2030. So you can see very quickly that not doing preventive maintenance, not planning properly in your operating and your reserve assessments drives you to a full replacement cost that is going to be exorbitant, and at some point will start negatively impacting your budget. In our case, almost 400 air conditioner units will have to be replaced, and many of the ones that we are still tinkering with are the older R22 systems, which haven't been made since 2010, which, you know, the gas hasn't been made since 2020. It was totally shut down. So there's a full challenge here when you're looking into the future. And my recommendation to board members is that you look at the replacement cost and ensure that, one, your reserve costs are accurate, and you can help that by going and getting quotes from licensed California contractors on what it would cost to do a replacement, and that you're funded, and that you're looking and talking with those California contractors about what can we do to do an annual or semi-annual maintenance, because the replacement costs start rising exponentially. Let me give you another example on full replacement. So this community that I live in that's 18 years old had never had a termite inspection. And the board was like, why do we need a termite inspection? So we had a termite inspection. And guess what? We found live termites. We found termite damaged wood. We found dry rot fungus conditions. And we have this year an $85,000 bill to replace wood components that have been destroyed by termites. Again, had they been doing termite inspections, had they been treating, and we did do a preventative this year with a borate-based substance to slow those wood-eating critters down. They don't like it, but it's safe for us. It's like 20-multine borax. The key thing is we're going to slow those full replacement costs down from damage to wood components by properly maintaining them. The other thing that happened is 7 or 8 years ago, when we had a painting project, the painter did a poor job, did not properly seal the wood. And the current contractors that we had out, and we just awarded a painting contract, have all said your wood was never properly sealed on the last painting contract. That's why you have such high amounts of dry rot and degradation on these exposed wood components. So again, if you do the proper painting and you get a valuable contractor and they do the job correctly, and you have to watch, you have to maintain, you have to make sure they're doing what they're supposed to be doing. And we'll talk a little bit about that in a minute. The bottom line is, then you don't end up with a full replacement of wood components because they weren't properly maintained. So I think that's the takeaway.
On the air conditioning units, do you have to crane them on and off a 4-story building, or are they able to lift
No,
them?
fortunately, Bill, the 4th story, the parking garage goes up to the top, to the roof. So the guys were able to actually carry those across the roof and change the roof units out. But what we've got now, because they haven't been maintained, because again, prior boards didn't want to do it, and even tried to seek legal opinion that they didn't have to do it, and legal didn't come back with that opinion. The bottom line is we're having to change those out, and we The other thing that we had a problem with was we had some contractors that did not do a competent job. So there are contractors we no longer will do business with. And we have 2 or 3 contractors that will work on this, but it's about a $2.5 to $3 million bill for the association that was not properly handled through annual maintenance or semi-annual maintenance, and certainly the replacement costs are going to be almost prohibitive. We've put that back in the budget, but we're behind the power curve.
Yeah, it sounds like it. How are you dealing with the issues that the air handlers and stuff in the units? They're getting up there in age too. So
yeah, so what happens is our technicians, the technicians that we use, commercial contractor, when they come in and find that the internal units have degraded, rusted out, failed, we have to replace those as well. So both the evaporator and the condenser units are being replaced as they find that they have degraded. But again, there's not a scheduled maintenance program on that because I've got a reticence on the board to increase the assessment to handle that. And it's intrusive for 390 units to have a technician physically come in and check your system.
yeah, no, it's very time consuming, scheduling and everything else. So are you finding that if you have to put air handling units and stuff, they're fitting in the spaces you have, or are you having to deal with different issues with that as well?
So far, we've been good. And that's one of the things that I discovered in the article I wrote for the OC View, is that when you get into these new systems, the new gases drive the mechanicals. So the mechanical form, fit, and function may not be exactly the same for internal units, and that could create a problem. We have yet to run into that, but I am concerned about the internal units because, again, this is a 20-year-old design, and the new units so far may be fitting in fine, and the newer units in the future may or may not. We just have not crossed that bridge.
Yeah, interesting. Yeah, it's never straightforward as you think it's going to be, and even trying to figure out how to budget for all this, and all the little nuances come up when you start getting into these projects. I think your comment about going out and getting live bids from contractors, you know, my recommendation used to always be, you know, start about year 5 before that component becomes, you know, it needs to be replaced, and then take a hard look at different issues, because sometimes things are overlooked in reserve studies. Access, you know, do you have to crane a unit off the roof, or can they lower it down and take it in some other way? Sometimes those things don't get considered into the reserve study. So
that, and the cost of the construction manager doesn't always get factored in.
Right. And
that's a good point too, Carly. So, you know, most reserve studies don't have construction management as part of that as well. So
absolutely. The last example I would give is the community I live in has a construction defect in the roofs. It was not dealt with in a construction defect lawsuit. It's now in the hands of the owners. The reserve study assumption was that we have concrete tile roofs. Those are 50-year roofs, and all they accounted for was tile breakage based on golf balls, because it's a golf course community. The problem is that the underlayment has a 24-year lifespan. And the way that the builder allowed their subcontractor to put the underlayment on the roofs and leave it exposed to the sun for 3 months. What our professional engineer has found is that the underlayment, the weatherproofing, waterproofing layer has totally disintegrated. I mean, if you reach down and grab it, it will crumble in your hands like ash. And this year, like I said, we've spent $125,000 in repairs, and what we're finding is leaks that have been occurring for 10 to 15 years. I mean, whole sections of roofs that have rotted out, and only the tile is holding itself up. So we have a $2.5 million replacement that we're going to have to do. And so we went out, we got a bid from a viable contractor, and we plugged that into the reserve study. But the reserve study still assumed that we have, 30 years left on, or 20 years left on the concrete tile. So we're having to fix that this year. That was the biggest driver in our assessment increase this last year, is that we either are going to have to do a special assessment, get a loan, or try to handle this through increased assessments in the future. And we are using, and we'll cover this a little bit later in our talk, we are using a professional engineer on the roofs and on the construction defect that we have with stucco and sheet metal flashing, because none of us have the qualifications to deal with the technical issues. But we're going to cover that in a little bit.
No, I think that's super important. And I think you brought up some other things like the other costs that don't get considered is how much does it cost to actually do a special assessment, get a bank loan, have somebody's company like Carly track all the finances and everything on that. There's a lot that goes into those. And I see a lot of associations that say, oh, we'll just pass the special assessment and get a loan to do that. But then there's a lot of additional expenses that get involved in that process. Okay, so fairness here, Northern California prices, you probably can do better in Southern California. Your costs are a little bit less here, but these are kind of things that I just kind of going to go through just kind of to make people aware of, you know, what it costs to maintain something versus what it costs to replace. So we're starting off with Richard's fence example because I don't know how many of these things I see that don't get maintained. So the paint, you know, wrought iron fence properly about every 3 to 4 years is usually about $4 to $5 a linear foot. If you maintain them properly and don't get a lot of rust, it can be less expensive. And it's about $50 a foot to replace these types of fence components. So it's not cheap. And as Richard said, if you maintain them, they'll probably last about twice as long as if you didn't. So metal concrete stairs are one of my big bugaboos because there's been so many code changes to them over the years, and most of the cities are not letting you replace them like for like. So this happens to have upgraded handrails, and it does have a small return on the left-hand side. But as you see, it's got what they call open risers where you can see through that. So most of the cities are making you go back with closed riser systems. This does have the wheelchair fence on the side, but it doesn't have the cane fence on the bottom. There's a lot of code changes on stairways. A lot of times they required upgraded footing. So I've seen these things run anywhere from the low 20s to the high 30s to replace. And so many of them are not maintained. The area, particularly between the concrete tread and the steel stringer on the side that's green, collects dirt. And about every 5 years or so, somebody should go and clean those out, prime and paint them, and make sure there's no rust accumulating in those because these systems can rust out fairly easily. And then you'll end up having a failure. Typically, we see failures when people are moving large appliances down, or if there's a large group of people leaving it at the same time, like if there's a fire or something, that a tread will actually break off, cause a safety issue. Wooden stucco, the painting thing is one of those things where I can't tell you how many times I hear associations, well, we're kind of short of money. The paint still looks good. You want to repaint the paint while it still looks good. You don't want it peeling off the building. It's just going to cost you a lot of extra money and prep and everything else. So, and I think Richard mentioned quality of the paint job makes a difference too. So I would not, recommend putting a single coat paint job if you're planning on it lasting a long time. It really doesn't cost you very much more money for the extra paint, the extra coat of paint. And most of the paint manufacturers will also increase their warranties substantially. There's a huge difference in the quality of paint. You can buy the low end or the high end. Sometimes it makes sense to do the high end, particularly if you have a community that has access issues, if you have to put scaffolding up and things like that to paint, depending on the elevations, that can be very expensive. So it's probably cost effective to look at going with a higher grade paint and maybe stretching out the repaint cycle. But painting, painting is about $1.65 a square foot. If you do a 2-coat proper with, primer, things like that. And to replace wood siding runs anywhere from $14 to $25 a square foot these days, depending on what type of siding it is. Stucco replacement has gone up substantially the last couple of years, and we're seeing it in the 30s. I've even seen some of it from stucco subs come back in the $40 per square foot range. So you want to maintain these systems. You want to keep them sealed, keep water intrusion out, so you don't have issues. And, painting is probably one of the least expensive ways. It also makes your community look great and keeps your property values up. So
Bill, I'd like to share a little secret with all the people attending here today that may save you in the long run. What you'll typically have is you'll have a painting contractor want to come to you, and they're going to want to paint your association. Danger, danger, Will Robinson. Don't start with a painting contractor. Painting companies like Dunn Edwards, Sherwin-Williams, Behr, and others will have professionals who can come out, do an assessment, and write your painting contract specs for you. Okay. Don't have a painting contractor write the specs. Have the paint company write the specs. And then that way, when you have your industry walk with hopefully 3 or more painting contractors, they know who those people are. They understand the spec, and you're not putting yourself in the awkward position of trying to figure out what kind of paint do we need, how many coats do we need. You're going to get that information from the professionals in the industry, and they're going to help you make sure that technically you put the right things into that RFP. We did it here. We had a lot of discussion with the 5 different companies. We went back and we revised the spec, or actually the paint company representative revised the spec, came back, and we have a bid quote, and the bottom line is we made our award, and we'll probably have painting starting next month here. So this is something that is really helpful to a board. You don't have to shoulder this yourself, and your community managers probably are aware of this. They may not do it if boards say, we want to do this and we want to do that. My recommendation to you as board members is you want to make sure your community manager is reaching out to one of these professionals from any of the companies. Those are all good companies. Have them do the hard, heavy lifting for you. It makes life a lot easier.
Yeah, Richard, that's a great example too. And it's probably one of the free services that, associations get. It's like having free construction management. The other thing that a lot of them will also do is they'll do color renderings and stuff if you guys want to change colors. So they can do computerized renderings. They send it into their design team. They come back with all kinds of different options. And then you guys can go from there on color selection as well.
The other thing that they'll do is, in our case, the rep from the company is going to be here like once a week during the process and make sure that they're using the right amount of paint. Now, we have a good vendor. He raised that issue and wants to make sure we understand he's using the right amount of paint. He will use the right amount of paint, and he knows that the industry rep is going to be checking. So we have a process in place this time that didn't occur 7 or 8 years ago that I think is going to improve the quality of what we're doing. And again, it's free.
Yeah, it's a great deal. And you're right. The reps will come out and they'll do mill thickness checks and stuff like that in order to maintain the warranties.
Yep.
And I think, one of the things that I think at the end of the project is to make sure you get the warranties and stuff from the paint manufacturer and you put them somewhere where you can find them. Because I can't tell you how many times I ask for people for their warranties and they go, we have no idea where they are. So flat roofs, or low slope roofs, as I think most of the roofing industry calls them now, they definitely need to be maintained, and they should be looked at. I say at least every 2 years. As they get older, you might actually beef that up to an annual inspection. You can really stretch the life of a flat roof if you maintain it properly. You can fix any minor issues where there's seam issues, flashing issues, debris collecting, different types of things happen on these roofs. It's about a 7 cents per square foot cost to have them come out and do a maintenance inspection and tune-ups. Usually a little bit less when the roof's new, sometimes a little bit more as the roof gets old. Replacement costs for roofs run anywhere from about $35 to $45 per square foot. So it's definitely something that's worth doing. And then Carly can probably talk about the ramifications when the roof leaks. So
yeah. I actually had an association that we took on, and they had roof tiles that were falling in to the unit homes because there was no underlayment. So roof, inspection maintenance is probably your most important. It's your biggest asset.
Yeah, and I think in the current situation with the insurance debacle,
Yeah.
everybody's trying to keep claims as low as possible, so they don't get dropped, from something. And you have a major roof leak, it can be pretty expensive.
Between the remediation, the patches inside, which would be the HOA's responsibility as well.
So, Any roof issues over in your neck of the woods there, Richard?
Yeah.
I like having you on. I like having you on here. You've got everything. You've got
Yeah,
three.
well, you know, 3 associations, 2 are 18 years old, 1 is 8 years old. I have to point out that on the flat roofs, again, an annual maintenance, a check to make sure that around the flashing that it's properly sealed will go a long way to preventing water from getting inside units. We had that happen in the city block size building in Anaheim, and had to have work done. We don't have an annual maintenance inspection for the flat roofs, okay, which is to me totally ignorant, and I'm working on getting those things. I've only been on the board for a couple of years, but I've been an owner for 10, and these are irritants to me, so I'm working on getting that changed. Brand new community, 8 years old. We haven't been doing annual inspections or semi-annual inspections because it's new, and we rode that until the rains this winter, and we actually had a leak around flashing into a unit that we've had to remediate. And so now I've told the board, guess what? We are on an annual inspection, because the thing we have to do is make sure that all those pipes that go up through the roof, that all that flashing is properly sealed so we don't get leaks, because if it does leak, we, the association writ large, get to pay that bill to fix everything, including what's inside the units. And then, of course, I've got a major construction defect in the community I live in, where we have disintegrated underlayment. We have flashing that was actually put underneath the underlayment, so it directs the water under the waterproofing, and issues along that. So this is an area that really needs to be paid attention to. You have to find a good vendor, and you want to find out root cause. When they go up on your roof and they do something, you want to know what the cause of this problem was. We don't use a particular roofer anymore because they never provided root cause. They never told us why. They just love to come out and open up 200 square feet of our roof and do repairs. And when I got on the board, I changed that, and we brought in a professional roofing engineer who did destructive testing and found we have a construction defect.
Interesting. Now, Carly, do you have a lot of issues with mechanical equipment on roofs, with other vendors
going up there? Yeah.
The cable guy. The cable guy is my favorite, that drills a hole through the roof.
Yeah. Yeah, we have many of those. We have homeowners that have condensers on flat roofs, so their own HVAC vendors will go up, and when you don't know who, when, what, or where, and something happens because they step on the wrong part of the roof, or they put it in incorrectly and it causes damage to another unit, you have to go back and figure out who it was. So we have put a lock on most of the roofs so that a homeowner has to call with their vendor in hand, so that we know who's going up at what time, so that we can track it back to if there is damage.
Very good.
Yeah.
Well, with the SB 326 deck inspections and stuff, this is, the deck coding is becoming a big topic. So I don't think I have seen, I've seen very few reports that have come back saying that deck coating maintenance doesn't need to be done. So basically, these waterproof deck systems are usually a multi-layer system, and then the final system they call them UV maintenance coat. And those maintenance coats need to be redone every 5 to 7 years. And most of the people, they're balcony decks, they don't see them. Unit owners, they're unit owners. They're kind of difficult to do because you have to coordinate with all the unit owners. I always say, if you're on a 5 to 7 year paint cycle, include your decks. Somehow they always seem to get left out, but it's a great time to do the deck maintenance while you're, doing everything else up there. When you let the system fail, just the waterproof system, they're running about $23 a square foot to actually do the waterproofing system. And then if you let it go down to the plywood level where all the flashings and everything have disintegrated, you're at $45 per square foot. And God forbid, if it gets into the structural part of the deck, then we're into a lot more money. So I think that, what we're seeing from SB 326 is that a lot of these systems haven't been maintained correctly. We're seeing, huge wholesale deck replacements on numerous communities, and a lot of these people, dealing with huge budget issues on these as well. So, yeah. You any deck issues, Richard? Or are you guys good in that department?
Generally, we're okay, although I will tell you a anecdotal story. In the community I live in, the decks were recoded 3 years ago, professionally recoded, and we have the report, and we had one deck that had an issue, and we had to put down a new fiberglass layer. But we had an owner of a downstairs unit, because these are upstairs, downstairs townhouse condominiums. We had an owner of a downstairs unit that said there's all of this rust and corrosion and issue with the deck up above me. We went in their backyard and looked, and there was tremendous rusting, and it's the only one out of 174 units to do that. So we got a professional company up there who checked the deck, and the owners of the unit have been allowing their dogs to urinate on the deck for the last 3 years. And we just had to replace the deck at a cost of $12,000. What disturbs me is it's the only deck in the community that has happened to, and according to the contractor, it's 100% traceable to the dog urine working its way through the coating material, which was done 3 years ago, and destroying the deck. So
yeah, it gets down to the flashings and it rusts all the flashings.
Absolutely, and they found that, and they have photos of that. And of course, the owner comes to us and says, "Oh no, it was the rain, it was the trees, it was the this, it was the that." And again, it's the only deck in the entire community that happened to. The other thing that I will tell you with the SB 326, the Stadium Lost community in Anaheim had a construction defect lawsuit, and one of the things that we found was 4 of the upper balconies had such water degradation that when Steve Norris, whose name pops up in a lot of things in California, when the professional structural engineer, went in, he literally took his hand and he grabbed 2x4s and crumbled them in his hand on these 4 decks. That's how severe the degradation was. And we're getting ready to do the SB 326 inspections on all the other decks, but that was part of our construction defects. So this stuff has to be taken seriously and looked at and dealt with immediately, because the liability is just astronomical.
Well, I think your pet example, and I have seen that a lot, where the pet urine rusts all the flashings out, is a prime example of about where rules and regulations come. Most of the deck coating manufacturers also want to have, pots elevated with saucers in them, because the other problem you have is that a lot of the fertilizers also will rust out all your flashings as well. So if you have the balcony gardener, sometimes, and they like to water a lot too. So you're just applying more water to the deck all the time. So those are issues I see. The other thing is a lot of times these systems aren't designed to have, AstroTurf put over them and different things like that. So having a good set of rules and regulations related to your deck systems and working with your manufacturer of the deck membrane so that you're following them will also extend the life of the deck. The pet one's a tough one though, I got to tell you.
So for the pet one, I've had that issue, and we only caught it because it was going down to the unit below. So we called him out. I mean, we did the fine policies, so courtesy notice, fine, hearing notice, all those things, to where they finally stopped. But it took a lot of work from the board and the HOA to get them to stop. It's a lot of work.
So one of the things I've noticed over the last few years, and I'm not sure if it's just a transition in people, is a lot of communities aren't maintaining their asphalt any longer. I go into all kinds of associations. I see failed asphalt, alligatoring. They hasn't obviously been sealed in years, things like that. Asphalt sealing is super inexpensive. It will really extend the life of your roads and driveways and parking areas. Replacing asphalt is a huge project, very intrusive. Don't get me wrong. I know asphalt sealing is not the easiest thing. And I think people get tired of having to deal with the people that drive through it, don't keep their cars or don't move their cars and things like that. It's definitely a management a management challenge. Let's
Yeah.
put it that way.
Yep. Especially if you have one access in and one access out.
Yeah, so you have to deal with those issues, but I think that once you get done with it, and it usually only takes a few days.
Yeah.
Well, the community looks great. It makes kind of refreshes the community, and I think it's one of those things that you didn't spend a lot of time on replacing asphalt down the road. So
one of the things real quick on this, and I'm running this with the 18-year-old community, is we just had our asphalt slurry seal, and both the professional engineers that we hired to orchestrate this project and the asphalt company, both of them told us this asphalt's not going to take any more slurry seal, that we're going to have trouble with it sticking to it. You get to the point where you have to mill the top layer in order for kind of a restart on the asphalt. The other problem that you may run into, and this community has it, is the way that the builder did the fill. We've got places where there's 65 feet of fill in this community. What they packed everything in with created an issue where we get water pushing up on the underside of the asphalt, and it degrades our asphalt. So
yeah, that will do it too.
We're going to have to spend about $500,000 in 4 years to do not just the remove and replace the milling of the upper layer, but dig down in some places 1.5 feet to put in the appropriate roadbed material and put drainage in so that we handle the water. We get the water to stop pushing up on the bottom side of the asphalt and breaking our asphalt up. So that can happen in a community. And again, that's another reason for having a professional engineering firm do an analysis and provide recommendations.
Now, Richard, I haven't heard the thing where you got to a point where you can't recoat the slurry seal. So Carly, have you had that happen yet?
Yeah, actually, I just had it happen, and we had it.
How old's the community?
Huh?
How old's the community?
The community is actually only 10 years old.
Oh, wow. Okay.
And so we are in SB 800. We believe it's part of the defect for the community because the asphalt's not that old, but we put down a slurry and it is currently coming back up. So we are going through that right now.
Okay. Richard, what's it cost to have the abrasive to go and abrade the old slurry seal off? Is that expensive?
So the estimate from the engineering firm, their engineering cost estimate was about $500,000 for our community. So we've got 46 buildings in the community, and it's laid out kind of like your thumb. Find my thumb here. So it's kind of like that with 2 major north-south streets, and then we've got 5 east-west streets. So it's a good amount of asphalt, but it's going to cost about $500,000, and it will be intrusive when we do it.
Yeah, I would think so.
Yeah.
So do you think this is something where the reserve study companies have overlooked this? Because I haven't ever seen that line item in a reserve study.
I really believe that this is an area that they need to go back and look. I think the estimate was every 15 to 20 years you need to do the billing on these, but literally as Carly's experience is, we're having a problem with the places where the slurry seal is not sticking, and I've got angry residents, and I'm like, they told us beforehand that we needed to mill, but we didn't mill and we didn't do the other repair because it's a $500,000 project.
Sure.
And we're trying to put the money in the reserve to do this. So we're targeting 4 years from now to do that level of work. But it's also going to require drains to solve the other construction defect issue. That even though the board in 2012 had a report from an engineering firm said it was a construction defect, they did not include it in the construction defect lawsuit. And there's no explanation why.
That's interesting. Well, anyway, I think this is one of those overlooked things. I think streets are overlooked. And as Richard just example, can be huge dollars if you have issues and problems with them. So I think it's, I think people, get focused on the building and landscaping and stuff like that. And sometimes our hardscapes, not just asphalt, but sidewalks and other things kind of get overlooked. So I will be talking to the reserve study guys about the grinding of the seal coating though. So that's a new one on me. So, all right.
So community maintenance plans. So those are different than your reserve study. You use your reserve study to form a maintenance plan. The maintenance plan is used to oversee and ensure the maintenance of your association's assets. So kind of like what we've been saying, you maintain certain things, and in your plan, it will tell you when those things are come up due for inspection, maintenance, and all the things that it should pertain to. So I have an HOA that we have an entire spreadsheet. It's about 4 pages long. It has every asset that they have, and we pulled that from their reserve study. And then from there, it has which month we should start getting bids and which month the work should be completed in. And then it has side notes of, if we've changed a month and the reason why, so that in the future, if they do change management or if the board changes over, there's always notes and history on the reason for the maintenance plan.
Now, Carly, do you fund the maintenance plan typically out of your operating account, or do you put line items in your reserve to cover it?
It really depends on what it is. So for instance, for trees, those have to be maintained annually. I have some associations, they do it out of their operating account because it's a low cost, they can budget for it annually. And I have some that have put a line item in their reserve study because they do it every other year versus every year. So it really just depends on the item and how often they maintain it.
Richard, how do you handle it in your 3 communities?
So for trees, what I do is I ask the landscaper company that's doing our landscape work to give me a 3-year cycle. That's their recommendation, is a 3-year cycle on tree trimming. And so I have that for the budget because again, I'm doing the financials for 3 HOAs, and we have a lot of landscape in those HOAs. So by getting that 3-year cycle, I plug in for this year's budget, next year's budget, the following year's budget, that annual operating expense. So it will vary because when we have to do the major tree trimming in like year 1 and year 3 or year 2 out of the 3, the cost goes up. But I have that planned. The community association management team has that in their planning schedule for the community maintenance plan. The other thing that I do, which I think is very unique, at least in talking to other treasurers, is I do a monthly treasurer's narrative report in writing to the board. One, because even though they're supposed to be looking at all of the documents, they are busy, they have lives, and they may not understand what they're looking at. So I do an analysis and provide that. And one of the things I do with our community maintenance plans is I include in my narrative report when we're supposed to be doing X, Y, or Z and what the projected cost is going to be. That helps the board understand that we've got these costs coming up this year or next year. I'm actually trying to develop 5-year strategic maintenance plans, starting with the reserve and looking at what our actuals are, and then working with the community management company to drop this in to a standard best business practice.
Great. So.
Okay, so implementing those plans. So if you've taken the time to look at your reserve study in depth and you're working with your community manager on a community maintenance plan, both annual, semi-annual, and then longer term. And I use annual and semi-annual out of operating budget, and the longer term, anything beyond 2 years, coming out of reserve. Then you can focus on when you need to do these projects. And if they're a major project, one of the things that I heard from board members frequently is, we don't have the expertise to manage this. We can't handle all of these projects. Well, the projects are due, and they're due when they're due. So what do? And what you do is hire a general contractor. So we bring in professional engineers for the streets. We bring in professional engineers for the stucco, metal sheet flashing, and weep screed repairs. We bring in professional engineers for the roofs that have to be done, so that we have bona fide engineering assessments and they can guide things, and then that helps us in working with the contractors. As I mentioned earlier, in the case of the painting, the industry is going to help us with the painting contractors, making sure that that is managed properly. The other thing that I think is really important is having a board member who has the time and the interest, engage with the contractors, be the rep from the board from the HOA. And so I'm the Stuckey. I retired a 1.5 years ago from my work for the Air Force. And I am the person who's out there talking to the contractors. So later today, we have a major reconstruction experts team in here removing damaged sheet metal flashing and stucco and getting it repaired. And I will go walk the community with the site lead to see the progress and to make sure that any change orders that have to occur or any quirks are being dealt with in a timely fashion. And literally they have my phone number, and if there's an issue, they call me and I go right there and we deal with it. That really helps when you're implementing maintenance or repair plans, either one. The other thing that's important, I think, is that a board member, a couple of board members should really be looking at things like termite inspections. What's the impact? Because if you just get the termite work done and you don't look at it, you may not find out you have dry rot that needs to be done. That's what we found. We've got an $85,000 bill to replace dry rot. And so there's a lot of help available to us because we are volunteers. I am not an engineer. I was a program manager for the Air Force on major defense programs. I've got a clue about finance. I've got a clue about engineering. I've got a clue about science because I work with them and contracts, because those were my team. Those were the people who fed me the information as program manager, but I am not that specialist. And so I encourage board members to use these specialists because they're going to give us truth. And we're not just listening to a contractor say, yeah, you need to do this and it benefits them. You're going to hear from an engineer who says, you need to do this, you don't need to do that, and these are options that you can decide to do. That's the importance of having these kinds of people in implementing your community maintenance plans.
Yeah. Okay. Richard touched a lot on developing funding plan and budget. So did Carly. We can kind of go through the different things, but I think when you talked, Richard, about a 5-year plan, I mean, that's awesome. Mm-hmm. It'd be nice to get every community looking out 5 years ahead on what's coming down the road. I think we all get kind of tunnel vision. Everything's kind of done on an annual basis. So we kind of get stuck in that little 12-month cycle versus looking, another 60-month cycle, which I think ends up being better. Carly, do you have a lot of associations that do long-term funding plans?
Not a lot of them. I got, I manage myself about 14, and out of that, about 5 or 6 do long-term budget planning.
Yeah, I think it's one of those things that as you get more involved in your communities, kind of get used to everything. It's one of those things, if you're like Richard, retired, and I said, can we clone you?
Yeah. You want to be on one of my boards?
It's very helpful. It's very helpful, I think, and it keeps the surprises down. I think you can really kind of start leveling out your funding and not have the big ebbs and tides and budget shortfalls that seem to be kind of the norm these days. So
the one thing that I would point out on this last bullet point, in California, we're required to do a zero-based budget. When I became treasurer in the community where I live, I discovered they were copying the budget over from one year to the next, to the next, to the next, because
no, you're kidding.
Nope, I kid you not. And the board's philosophy was that they weren't going to raise assessments, even though the cost of living was at 3.5%. The utility costs were going up. So they would establish a budget that, let's say, required $150 per unit per month, and they were assessing at $120 per unit per month, and then just underfunding the reserve in order to make up that budgetary requirements. So the bottom line is there's a hand in hand of the operating expenses, the reserve expenses, and we need to be looking at that each year.
I agree.
So why do you have a funding plan? So the association I'm living in right now, the board deliberately in 2009, and it's in the minutes, decided to underfund the reserve by 15% because they disagreed with the reserve specialist that money was going to be needed. The end result over 15 years was that the association was underfunded by more than $1.1 million. And it was compounded by the fact that they deferred maintenance. So You're not, and I have a board member that I had to explain that deferring maintenance is a liability against the corporation. Okay, that bill is coming due and it's going to get more and more expensive by not doing it. So it is not beneficial to the association to defer things indefinitely. We made a decision on the streets to do a slurry sealing and to do some selected repairs because we didn't have the funds to do the $500,000 project. But now we're on a funding cycle so that in 4 years, we have the funds in hand to do what will maybe be as much as a $700,000 job in 4 years. So you really have to tie in what you're doing with preventive maintenance, what you're doing with your long-term funding, and when's the target date that you're looking at, and work with your reserve specialists to make sure you're using real numbers so that they can do realistic projections, and they're doing projections to make sure that you think you're in the funding zone and close. I will tell you, my painting budget was 45% of what the actual expense was. And this year, the reserve had a major increase, over 20%, for the cost of painting the community because the costs have risen exponentially. So again, take a look at all of this, make sure you're getting realistic costs, you're feeding to your reserve analysts, you're plugging them into your operational budget, and you have a plan because the bill's coming due. And when you don't do that, it's like my friend who's president of a community in Huntington Beach, where 2 winters ago, when the roofs leak like sieves, they had to go out and get a $5.5 million loan to repair the roofs. So you don't want to go down that road.
So duty to maintain, as we've been saying, so the board has a duty to maintain, protect and enhance your community. As the boards should not get stuck on cost. Right now with inflation, I believe as of June like 23rd, inflation cost was at like 6.8%. So with that, even though it will cost to maintain, it costs far less to maintain than it does once the system is broken and you have to repair or replace it.
Yeah, just so over the last, if you think the last 10 years, construction costs have increased 100%.
Yeah.
So construction costs don't follow cost of living increases. So, and I think that's why Richard found his paint number being off, because I don't think, in fairness to the River City guys, I don't think they could keep up with the increases as fast as they were coming through.
Yeah.
So.
No, in retrospect, Bill, what we should have done, and I didn't think of it at the time. I thought about it for the roofs, and we did that. But if I had it to do over again, what I would have done is 2 or 3 years ago, gone out, gotten different painting companies to give us a ballpark estimate of what it would cost to repaint the community and update the reserve. We did that for the roofs, which helped tremendously, but we didn't think about it for the painting, and that was
I think if anybody's got any large reserve study projects coming up in the next 3 years, you should be getting numbers now, because my guess is the numbers in your reserve study are going to be low. So, and you're going to have to start, figuring out ways of, of working around that. So,
and contractors are busy. So if they're going to go out and do bids for numbers, it's going to take them a while to get out there and get you those numbers.
Yep. Particularly if you're not going to be awarding a contract.
Right.
But if you've got contractors you work with that you trust, get them to go do that, because that improves your reserve baseline targeting.
Okay, do we have questions? I don't know who's running the questions. Or Rachel, are you running questions? Do I need to give this back to you?
I have brought the president on. We do not have any questions in the chat. Yeah, I think you guys covered everything so great.
The one last thing is the next chart. We actually have the references to the documents, some of which were talked about in the last session with the reserve study and budgeting. These are some new documents out of CAI. They were announced at National this year, and I think they're very beneficial. Much of our presentation was taken from the best practices for community association maintenance and the CAI reserve study standards that were just released this year. And so what you have is the most current thing from CAI, and I hope you will keep this as a desk reference and take a look at those documents. They're very comprehensive. It's hard reading in one sense that it's a lot of new stuff. And I've gone through it and I will continue to go through it. And again, I think it's a great desk reference for you to have to be able to refer to something when discussions come up.
Great, thank you, you guys, to all three of our speakers. We will be back here tomorrow morning at 9 a.m. Don't forget, we have raffle prizes tomorrow. And we will see you all then. It's been a lot of information, so don't forget this will be recorded and put on YouTube. Rachel will be sending an email with the links. And all of our speakers have provided their information and are available for you to reach out to. So we'll see you guys all tomorrow. Thank you so much for being here.
Thank you.
Bye,
Thanks,
everybody.
guys. Bye.
Bye.